In this video we're going to update the 4% rule by looking at some UK based data and bring it bang up to date for 2022, and then we're also going to look at the sequence of returns risk and how it can impact you in retirement. So you might think that this graph is a series of different portfolios with maybe Scottish Mortgage being the blue line, but actually it's the same portfolio just with a different sequence of returns being applied to it. And it's amazing how a few bad years at the start of retirement can lead to ultimately a total collapse of your portfolio, and then on the other hand a run of very good returns at the end of your portfolio life can lead to the portfolio going off into the stratosphere. So in this video we're going to look a bit more detail into some of the withdrawal strategies and how to manage this sequence of returns risk. So for sequence of returns risk, a bigger determinant of your wealth could be the order of returns that you get rather than the composition of your portfolio. And in later life this matters a lot less due to things like the state pension kicking in, and positive returns will probably have preceded the negative returns, so your portfolio will have a higher value initially when it gets a big kicking from an extended bear market. So the safe withdrawal rate of 4% came from a Trinity study, and this was data up to 1995. It was US stocks and bonds data, so not directly applicable to us in the UK. It looked at a 30-year retirement period, and I have to question whether some of the older data is repeatable in the future because we had things like the gold standard in operation. So my solution has been to find some GBP data for a global tracker up to the end of 2022. So this is an example of past returns maybe not repeating. I put together my two least favourite things, Vanguard and bonds, and what do I get? A complete collapse in price and a 10-year low. And bonds have done quite well in the past, but I'm really not sure going forwards what we're going to see from them price-wise. This is an overview of my cash flow model. I'll put details of how you can get hold of it in the description. So it runs for 30 years. We've got product and platform fees 0.5%. We've got 100% stocks, which is a global tracker. Initially we've got our initial portfolio value, we've got our withdrawal rate that we set at 4%. So the best return is just over 10.5 million from our initial starting £1 million portfolio. Worst return negative 2.5 million, and we've got the years that we achieved those returns being 2000 and 2010. We've got 36 portfolios that pass and 4 that have a negative value and don't last the full course. So we've got a 90% success rate. It's a little different to the 95% of the Trinity study. We've got 27 portfolios that are worth more than the initial starting value after 30 years, although clearly inflation has had a massive effect in eroding the value of those portfolios over time. The key metric is not the percentage of times that the portfolio fails, but it is understanding what is causing the portfolio to fail in the first place. And some failures will need a very low safe withdrawal rate before they can be overcome. There's such a massive trade-off between risk and return. So in these instances it's much better to work around what's going on rather than lower your withdrawals in every single year. So here we have the MSCI World stock market returns in GBP from 1983, and it goes all the way down to 2022. And what you can see is there's only been one occurrence of 3 negative years in a row. It started in 2000 with the tech crash. So other than that, the global stock market has been pretty buoyant, and what we would expect is that the portfolios that fail in this scenario are actually the ones that start around this time period, which is when a portfolio would be most vulnerable to negative returns. and it's quite amazing how robust these numbers have actually been. And so the risk is that maybe, although we've had a negative 2022, this might carry on in future years. For the worst case scenario, as we can see here, we get 3 years of negative returns in a row at the start when we're withdrawing quite a lot of money, and the portfolio pretty much halves from its starting balance, and then it's just never really able to recover. So it's really useful to understand what's going on here so that we know exactly what the worst case scenario looks like. What happens if I change the safe withdrawal rate? Well, we need a rate of 3% to have absolutely everything working for us, which is pretty low. If we change it to 3.5%, we get 2 failures. Again, the worst year is 2000, and I think, yeah, the other year is 2001. So it was just that sequence of 3 bad years in a row that really hindered the portfolio. So next, what happens if we change the retirement period? If we change it to 40 years, we're now getting 8 cases that fail. Change the withdrawal rate down to 3%, and 1 failure, again year 2000, 3.5%, 4 failures. So possibly a higher failure rate than I'd have really liked, because we're only passing in 10% of cases. If I alter the stocks and bonds mix, it doesn't really change things a great deal, because the bonds hinder the recovery even though the drawdowns aren't as steep. Another thing that I can do is I can model additional product or platform or advisor fees, and here again we see an increase in failure rate, which is to be expected. Potential solutions to our sequence of returns risk would be, firstly, having a flexible withdrawal strategy, also known as Guyton guardrails. I've done a video on this and I'll put a link to it in the description and in the top here. You could maybe consider downsizing your property, although you'd probably be doing it during an economic slump, so that wouldn't be too clever. You could have large cash reserves when you initially retire, so say maybe 3 years or more, and then you could also top slice your portfolio so that if you retire and it does very well, you bank a lot of the money into cash so that you're preparing for the inevitable market downturn. You could potentially go back to work, either the same sort of job or a very different job. You could also start a side hustle. Some of them you can start quite easily in a recession, but others are much more difficult. So we built our safe withdrawal rate model using UK data, and it worked pretty well. If you're interested in it, I'll put a link in the description as to how you can get hold of it. But my conclusion is that the 4% rule ignores things like the state pension and other income sources. So for more accurate stress testing of your wealth in retirement, you need to build a model like the one I explain in this video. It's a much more detailed cash flow that looks at all kinds of scenarios, and you can really get a lot of depth and clarity around your finances.